AB 748 would shift oversight for continuing care retirement communities from the Department of Social Services to the Department of Insurance. This presentation discusses why we need AB 748. Insurance type obligations should be regulated by the Department of Insurance. California needs AB 748. Continuing care retirement communities involve insurance type commitments. These include required large upfront entrance fees, long-term care commitments, and lifetime contracts. Insurance type obligations are financially complex and technical and should be regulated by the Department of Insurance. Large entrance fees, $300,000 or more, are often required. Health and safety are regulated by the Department of Healthcare Services and the Office of Statewide Health Planning and Development. Financial and contract oversight is now under the Department of Social Services. The Department of Insurance is better qualified for these functions. Continuing care retirement communities are familiarly known as CCRCs. CCRC operators typically promise lifetime care in return for a large entrance fee. Entrance fees are comparable to the value of a single-family home. They often range from $300,000 to $800,000 or more. The entrance fees are like an annuity in which the purchaser pays a large amount up front to receive benefits for life. The health and safety aspects of CCRCs are regulated by the Department of Healthcare Services and the Office of Statewide Health Planning and Development. Regulation of the annuity-type obligations implicit in entrance fees is now under a small staff embedded deep within the Department of Social Services. The promise of lifetime care is offered as the inducement to enter a CCRC. Residents pay large entrance fees in return for that lifetime care commitment. Entrance fees are like insured annuities in providing lifetime benefits. Accepting of entrance fees is a trust undertaking. Entrance fees, like annuities, involve insurance features and are inherently actuarial. The commitments are for life, just like permanent cash value life insurance. With the typical CCRC entrance fee, the public pays a large upfront payment expecting future benefits, just like insured annuities. The state now provides no actuarial oversight for these complex contracts. All Californians face the risks of frailty and vulnerability with advancing age. CCRC residents contract with a provider, expecting that they will not have to burden the state for the cost of their long-term care. They deserve to be rewarded for that foresight with a financially sound, fairly managed CCRC. Many providers are tax-exempt nonprofit organizations, often religiously affiliated. which encourages residents to believe that the provider organization is an organization they can trust. CCRC residents save California money. The risks that CCRC residents face are the same risks that we all face as we age. CCRC's promise to help older Californians to manage those risks. Residents enter a CCRC knowing that they are likely to grow frail with age. They also know that declining mental capacity may leave them financially vulnerable. They seek the protection of a trusted CCRC provider. Providers encourage this by presenting themselves as trustworthy. Many providers are nonprofit. Like charities, they enjoy the same tax exemption and other privileges accorded to entities dedicated to the relief of the poor and distressed, or for the relief of the underprivileged. Nonprofit ownership connotes trustworthiness to many who are seeking a safe haven for retirement. Entering residents trust the providers with large entrance fees in the expectation that they will thus not be a burden to their children or to the state. Many providers claim affiliation with a church or other religious organization. That affiliation further encourages the trust that aging people seek and need. The technical expertise to make sure that that trust is well placed requires the same skills that apply to life insurance and annuities, which are also trust-based businesses. Many, perhaps most, entering residents imagine that they have the same regulatory protections as residents that life insurance and annuity customers have. They don't now have that oversight. AB 748 will correct this regulatory shortfall. By choosing to live in a CCRC, residents prudently seek to provide for their old age and thus to avoid becoming a burden to the state through Medi-Cal. These residents deserve to have their foresight rewarded. They should have the effective financial oversight that the Department of Insurance can provide. Contracts vary widely from CCRC to CCRC. There is no uniformity. Some providers shield residents from the financial risks of aging. They offer full care contracts. Other providers leave all or much of the risks with the residents, offering only limited benefit contracts. Few entering residents understand these differences. Providers use jargon to describe the differences, referring to the contracts they offer as Type A, Type B, Type C, and with similar contract designations. Thus, some providers shield residents from the cost risk of escalating care through full care contracts, known as Type A contracts. Other providers require residents to retain all or some of these risks. These contracts are confusingly called Type B or Type C contracts. They are limited benefit contracts. They are limited in that protections are limited to what the provider is willing to accept. Residents have to provide themselves for the protections that are not included in these lesser contracts. Type B and Type C contracts are less protective of residents than are Type A contracts. Few entering residents understand all the implications of these contract nuances. Entrance fees and the risks of aging are all similar to insurance risks. The Department of Social Services lacks insurance expertise. CCRCs, like insurance, involve technical mathematical concepts, and the mathematics of the CCRC is similar to the mathematics that underlies insurance. The Department of Insurance has access to interstate cooperation through the insurance zone system. Many states, or all states actually, but come together in zones to pool their resources to improve the regulation and oversight of insurance companies because of the technical nature of the liabilities insurance companies incur. The same kind of technical considerations apply to CCRC undertakings. The Department of Insurance also has access to the pooled resources of the National Association of Insurance Commissioners and the National Conference of Insurance Legislators. Both are organizations of regulators and legislators that come together to provide improved regulatory oversight. CCRCs are like insurance and need insurance regulatory oversight. To reiterate, the Department of Social Services does not now have the expertise to oversee these risks faced by CCRC residents. Actuaries are particularly skilled in understanding the mathematics of contracts involving risks like those of a CCRC. Not only does the Department of Insurance have actuarial expertise, but it is also able to draw on the cooperative talents of other states. This cooperation is accomplished through the long-established National Association of Insurance Commissioners and the National Conference of Insurance Legislators. California now lags states like New York and Florida in providing adequate oversight of CCRCs. That lag is evident in the large number of California CCRCs that are struggling under today's economic challenges. AB 748 is the vehicle that can help California to catch up with the other states. CCRC residents relieve the state of California of the cost of their aging. Californians should be supported in the fulfillment of the trust that they place in CCRC promoters and operators. AB 748 requires no state expenditure. That warrants repeating. AB 748 involves no state expenditure. It is merely a realignment of responsibilities to bring needed expertise to a complex industry which is very similar to the technical complexity of the insurance industry. CCRC residents have a right to expect the effective regulation of their financial commitment that the Department of Insurance is uniquely qualified to provide. AB 748 is overdue. Financial and contract oversight of CCRCs should be in the Department of Insurance.